Even though last year saw record highs in the value of the dollar, the last 6 months have shown a decline, with no signs of stopping anytime soon. Other countries are moving away from the dollar, probably permanently, meaning the end of the era of USD dominance. And while currency exchange rates can be volatile, one ever-growing number will always drive down your cash. It's time to protect your net worth. Before we dive into the safer assets, let's look more closely at why cash, ironically enough, is not a smart place to put your money. The dollar has been dropping steadily over the last 6 months, with most experts predicting the decrease will continue far into next year. Why is the dollar dropping? One reason is that we saw a huge increase in the value of the dollar in 2022. This is because the Fed has been raising interest rates to the highest levels in decades in an attempt to combat inflation. Higher interest rates meant more investors were seeking to invest in the US last year. But now the Fed is pulling back. Not only is the Fed pulling interest rates down, other central banks are raising their interest rates and tightening federal policy right now. This means that the dollar is going down while other currencies are increasing, closing the distance between them. Some currencies have already beaten the US dollar, like the British pound and the euro. The US dollar is the 10th strongest currency at the moment, and other currencies might be gaining on it to knock it out of the top 10. It's not just the actions of the Fed that are causing the decrease in the dollar. The US economy is likely headed toward a recession, which is not true in many other countries. While we're seeing negative economic data every month, many other countries are looking forward to a positive economic outlook in the next year or two. That means investors aren't looking to invest here as much as usual. That lack of investment interest means a lack of interest in the dollar itself. But we don't have to look at foreign currency exchange rates to know that cash is not a safe asset. The buying power of your cash will always drop over time. Why? Because of the nasty bug we've already mentioned: inflation. What is inflation? Inflation is the rate at which prices for goods and services rise. You've heard that movies used to be a quarter. Basically, that happens for everything. Over time, things get more expensive, and though you used to be able to take your date out for less than $1, now it's more like $100. You don't have to wait 80 years to see the effects. Inflation has risen by 17% in the last 3 years alone, and though the Fed tried to pull it back down, that number is going up, 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 while your cash's buying power will continue going down, down, down. You might think that putting your money in a traditional savings account would combat this, but it doesn't. The usual rate of interest on a savings account just doesn't match up to inflation. So even if your cash isn't just sitting around doing nothing, if it's not generating a high enough return, you are losing value over time. This isn't just true for the dollar. Cash in any currency is subject to the same risks. You may think that even if USD is not a safe asset, you'll be more safe holding the British pound or the euro. But even just last year, the pound fell to a record-breaking low compared to the dollar. It saw similar dips in March 2020, you probably remember why, and in 2016 right after the Brexit vote. The euro has been strong for decades, but last year it too saw a relative dip, falling to its lowest point in 20 years. Cash in whatever currency is at the mercy of government decisions, national economic performance, and even if those factors boost its value, it will still be dragged down over time by inflation. So if holding cash is a losing proposition, what assets should you hold instead? What are the safest assets that will outperform cash? First, let's clarify what makes an asset safe. When we say an asset is safe, we mean there's a high likelihood you'll get the return you expect regardless of market cycles or economic events. As we explore the safest options, keep in mind that risk usually comes with higher returns. A lower risk asset may yield a lower return, although these options will most likely still do better than cash over time. Let's start with the safest assets of all. These are in the risk-free category. In the risk-free category are bonds, notes, and treasury bills, collectively known as US Treasury securities. Government securities offer fixed terms and fixed interest rates. That means you know exactly how much you'll get back and when you can get it. Treasury bills, commonly known as T-bills, mature the fastest. These can cash out in 4, 8, 26, or 52 weeks. Treasury notes mature in 2 or 10 years. Treasury bonds take the longest, with terms of 20 to 30 years. Why are these considered so safe? Because they are backed by the full faith and credit of the US government. That means if the US government still exists when your term is up, they have to pay you the promised amount. If the US government has collapsed completely, you probably have bigger problems to worry about than your bond. These are also great assets to hold because they have high liquidity. How can they have high liquidity if they have fixed maturity terms? Because there is a large market for treasury securities. At any time, there are people ready to buy your security so you can cash out and use those funds somewhere else. There are other assets that are safe like these, but with slightly higher risk in exchange for a possibly higher rate of return. The top option in this category of safe but not risk-free is money market mutual funds. A mutual fund is a company that pools money from many investors and invests the money in securities like stocks, bonds, and short-term debt. A money market mutual fund is safer than that, as it does not include stocks or risky debt investments. A money market is more likely to purchase treasury bills, commercial paper, and certificates of deposit, most of which have almost guaranteed returns. Notice we said almost. Like other mutual funds, even a money market cannot guarantee earnings, but you are very unlikely to lose your principal investment. Because you won't lose out on your principal investment, money market mutual funds are much safer than cash. If you're looking for the protection of the US Treasury but want a higher return than the usual bonds, consider Treasury Inflation Protected Securities or TIPS. These are government bonds with a twist. The value of your principal rises and falls with inflation. The interest rate is fixed, but since the principal rises and falls, your total payments vary as well. At maturity, if your new principal is higher than what you initially paid, you keep the increased amount. If the new principal is equal to or lower than your principal investment, you get your original amount back. That means you are guaranteed to get at least your principal back, as well as the interest over the term. TIPS are sold in terms of 5, 10, or 30 years. So if you are looking for a long-term savings option that protects against inflation, this is a great asset to grab. If you know exactly when you're going to need your money, then certificates of deposits or CDs are a great option that's safer than cash. These offer a range of terms from 3 months to 10 years and have decent interest rates with a guaranteed return of your principal investment. They are also insured by the FDIC up to $250,000. CDs are not very liquid though, because early withdrawal can result in penalty fees or loss of interest. But if you know you'll need a certain amount by a certain date and no earlier, they're a great option that's much safer than cash. The final option we'll discuss is the least safe of those we've talked about so far, but it's still safer than straight cash. And it has a higher rate of return than the other options we've discussed. These are investment-grade corporate bonds. Companies sell these to gain capital to fund their operations. If a credit rating says a corporate bond is investment-grade, that means the company is very likely to pay you interest and return your principal. However, companies can go bankrupt. However, unlike stocks, the company will still be required to pay you something even if they do lose their money. Since there is some risk of a company failing, this is the most risky option on our list. But since these bonds have a fixed income, meaning the company is required to pay you a certain amount of interest regularly and interest rates to combat the higher risk, they are a safer and better paying option than cash. Why should you worry about how safe your assets are? Having cash at all should be enough to make you happy, right? Wrong. Common wisdom says that money doesn't buy you happiness, but the latest research says that's not true. It turns out no matter how much you have, making more money does make you happier. Except for one unlucky group of people. Are you in that group? Watch this video to find out and debunk the money versus happiness myth.